And as we look at credit risk management, the main idea is to look at how credit risk is managed by the different institutions that are offering credit to the different companies, entities as well, or individuals. So to look at credit risk management, we go back to the accounting equation, where with the accounting equation, we say your assets is equal to equity plus liabilities. So which means to finance the assets that the entity wants to acquire, there are two options of their sources of finance. The first one is to ask the owners of the business to contribute through ordinary share capital. And remember, the other one is the contribution from money that belongs to the ordinary shareholders through use of retained earnings. Then the other source of financing would be to ask external parties to finance the operations of the business. And this is through the loans and through bonds, right? So which means when you look at credit risk management, you are basically saying that these parties who are financing this entity or company or enterprise through either loans or bonds, how do they manage the risk emanating from this company? So when you look at credit risk management, you are looking at the management of the financing that is coming from loans and bonds from these parties, how these parties are managing this risk so that they are able to help the company finance as well. So, which means, please take note, for every entity, so this is debt financing. For every entity, having debt is not necessarily a bad thing. So for every entity, having debt is not necessarily a bad thing. Because remember, we are saying the entity wants to maximize the value of the firm. So the entity wants to maximize the value of the firm, which means that the financial manager is seeking to maximize the value of the firm. And to maximize the value of the firm, it means that they want to be in a position where they're able to minimize their cost and maximize the value of what? Of the entity. So which means that how do they do that? We know that generally the cost of debt is lower than the cost of ordinary shares. And because the cost of debt is lower than the cost of ordinary shares, it means that they want to be financing their operation of the firm at a point where the overall cost of debt is lower. The overall cost of capital is lower. And remember, the cost of capital in this case is when you're discussing the weighted average cost of capital. So they want to make sure that they are financing the company where the weighted average cost of capital is its lowest, so that they're able to maximize what? The value of the firm. So having debt for an entity is not necessarily a bad thing. But now, these parties who are financing this entity through loans, giving the entity loans, or through buying the bonds of the company that the company would have issued as well, it would mean these are the parties that were assessing from their perspective. So when you look at credit risk management, you are assessing from the perspective of the entity that is giving this company either a loan, or from the perspective of an entity that is what investing in the bonds that have been issued by the company. So which means, if you look at it typically, like for example, from a bank's perspective, the asset is equal to equity plus liabilities, right? So what do we see? So this is the party who's getting these bonds and loans, right? So here we're looking at it from the obligor's perspective. So the party who's borrowing money, we call them the obligor, right? Then this is the creditor or the party that is basically investing in these entities there, right? So which means from this party, let's say for example, if it's a bank or financial institution, the equity is the money that is coming from the ordinary shares, who are the owners of the business there, right? But the loans, the liabilities, it can the bank can either have loans or they can even have bonds. But the main element that where the money is going to be coming from is from the depositors, right? So the main element here is that the money is going to be coming from depositors. If you look at it from a bank's perspective. Now the bank now takes this money that they've raised here, and then they can now, or the bank or the financial institution takes this money that they've raised there. Now their assets would now be the loans that they give out or the bonds that they're going to invest in as well. So what do we see? In this case, it means the loans that the bank gives out is basically an asset to them, because that's how they're going to be generating what? A return or interest return. The bonds that the bank, the financial institution would invest in, it's also an asset to them, because that's the way they're going to be getting what? The returns from as well. So please, when it comes to a financial institution, you need to be able to understand what's happening here. The loans and the bonds that we're talking about, is it from the side where they are raising finance, or is it from the side where they are having what? Investments in different securities as well. So when you look at credit risk management, we are now looking at it from this perspective to say, if the company is seeking to generate returns through giving out credit, which is debt financing, then how are they able to now manage this credit risk? So this is where the credit risk comes from. So the credit risk is coming from this activity where the entity is either giving out loans or bonds or investing in this debt securities to generate what? A return. So the credit risk management is coming from there when you look at a financial institution that is giving out credit. Are we on the same page? Any question before we move on? Any question before we move on? For Rsk4804, so for Rsk4804, we're looking at credit risk management, and there are different topics that we're going to be covering, and the different topics also have chapters that fall under them as well. So you see that topic 1 looks at chapters 1, 2, and 3 of the textbook, and topic 2 covers chapters 4 to 10 of the textbook, and then topic 3 covers chapters 11 and 12 of the textbook, and topic 4 covers chapters 13, 14, 15, and 16 of the textbook, and then topic 5 covers chapters 17 and 19 of the textbook. Then topic 6 covers chapters 20 and 21 of the textbook. And lastly, topic 7 covers chapters 22 and 23 of the textbook as well. So please make sure that you refer to the study guide so that you're able to see exactly which chapters you must be going through in the textbook, so that you don't do the chapters which are not part of your curriculum as well. Now, how we're going to approach this curriculum is that we're going to go through these chapters sequentially based on the guideline from the textbook. Then what we're also going to do is that when it comes to the assignments, you will see that some of the assignments that are asked in Rsk4804, they ask you to assess a company of your choosing, or they, like for example, they can say use the different ratios to assess a company of your choosing, or they can say use the Potter's 5 forces, or Potter's 5 competitive forces to assess a company of your choosing as well. So which means that if that is the case, it would mean that how we assist you when it comes to the assignments is that you would see how we deal with it. You will see that if we ever encounter those questions, we'll give you a template of the guidelines of how to approach, how should you approach a typical company of your choosing. You choose the company, you use the guideline to answer the question. Then what we'll do is that you will now send those the proposed template to us, so that we now review it before you actually submit the final draft to the lecturer, so that if we pick out any mistakes there, we can now correct you before you actually submit the final draft of your assignment as well. Then for revision purposes, which we expect to start in November, what we're going to do is that we are going to go through the different past paper questions. Then if there's any other additional questions that we feel that we need to go through and cover, we'll also cover them during the revision period, which is from November, December, January, and February, depending on exactly when you write the exams as well. So that's basically how we're going to approach the whole curriculum until you write your exams in February next year. So, which means today our agenda is to start off with topic 1, which is the introduction. And today we are going to start off with chapter 1, which looks at the credit basics as well, to understand exactly what is credit and what are the issues that you need to be able to address when it comes to management of credit risk as well. Are there any questions before we go on to the textbook? Are there any questions before we go on to the textbook? Also, please note, sometimes you see that when we're having a discussion in class, maybe I'm discussing something and you still want to see the board, or someone is asking a question and you still want to see the board there. If you check under my tab, on the top tabs on your screen, if you check under my tab, which is written Rainos Muusha, and on that particular tab, if you check on the top right-hand corner of the tab, if you click on pin, it would mean that even if someone is asking a question and you still want to continue seeing the board, you will still be able to see the board as well, unless we are sharing something on the screen as well. So if you are sharing something on the screen, or what is in the textbook on the screen, if you still want to be able to see something and not having the distraction of someone discussing something in the background when they're asking questions as well, you can just click on that and you click on what? Pin, which means that you are going to be constantly seeing what I'm just sharing on the screen or on the board as well. So please take note of that as well. So if there are no questions, we are going to jump straight into chapter 1, which looks at credit basics. So I've just introduced you to exactly what credit is in general. So when you look at the issue of credit, please make sure that you take note. Always bear in mind that having credit, whether it's an individual or it's an institution, is not necessarily a bad thing. But now, management of credit is what is needed, or management of the credit risk is what is needed, mainly because we know the more credit an institution is utilizing, the higher the risk. So the higher the credit an institution is utilizing, which is basically the more leverage an institution is utilizing, the higher the risk as well. So which means that that's the point now that you always have to make sure that you bear in mind. The higher the leverage, the higher the risk an entity is facing. So under credit basics, if you check on page 4 of the textbook, we look at section 1.1, which looks at the meaning of credit. And on line number 3, they say, roughly, we can define credit as a transaction between two parties in which one party, the creditor or the lender, supplies money, goods, services, or securities in return for a promise of future payment by the other, which is the debtor or borrower. So such transactions normally include the payment of interest to the lender. So which means that because you are the lender is deferring consumption of that resource that they are giving to the borrower, it would mean that they would expect to be normally they would expect to be compensated. And how they are going to be compensated is through payment of what? Of interest. So which means credit is not cost-free. So the credit itself in its nature is not cost-free because it's not cost-free because the lender has to be compensated for deferring what? Consumption of the goods or service of money or goods or service there as well. On page 5 of the textbook, line number 4. So on page 5 of the textbook, on line number 4, they say, naturally, a small percentage of debtors won't pay back the credit as promised, sometimes even sending the creditor into bankruptcy. But the majority of debtors meet their commitments. So that is why the world economy survives. Credit losses or bad debts occur in both finance and non-finance businesses. So the reasons vary. In certain cases, if the credit is extended to crooks, it is a bad debt from inception. However, the bulk of the credit losses happen because of genuine business failures. So the reasons vary from increase in competition, new technology, substitutes increase in prices, increase in prices, decline in demand or overestimation of demand, oversupply position in the market, government regulations, union problems, mismanagement, death of key personnel, business cycles, overambitious projects, financial losses, excessive leverage, concentrated exposure, defective diversification, and so on. So a proper credit risk analysis will bring to light the probability of credit loss arising out of a genuine business factor. So it will be very, very important to see exactly how we would be assessing the credit risk of the different entities, considering that we are going through a pandemic as well. So what do we see? It means that when you look at our business cycles, the business cycles are going down mainly because, or the business activity is going down mainly because many companies actually are not having the demand that they would usually have from the customers because of the issue of the pandemic as well, and because of the lockdowns as well. So because of this, it would mean that the credit risk at this point in time is expected to be high. But it now depends on exactly what type of institution you're going to be dealing with, how much, whether they are IT-based companies or other different industries as well. Because remember, other industries are thriving and other industries are struggling, especially if you look at industries where you look at the ones that sell and distribute alcohol as well. So there are situations where the creditor ends up losing even if the debtor settles the dues on time. 3 such situations are described below. So the situations where even if the debtor pays on time and still they suffer losses. The first one instance is inflation. If the rate of inflation exceeds the interest rates, the suppliers of credit are badly affected. So if inflation is too high, it means that it basically means that the supply of credit is going to end up losing out on their money as well. Like for example, to give an example, if someone borrowing 600,000 to buy a house, if interest is 10% and inflation is 20%, what do we see? The supply of credit, which is the bank. Now, what do we know? When it comes to the cost of credit, which is the interest rates, if you look at from undergrad as well, we know how we calculate your interest rate. When we say your nominal, generally your nominal rate of interest is given as your real rate of interest plus inflation premium plus risk premium as well. So your real rate of interest plus inflation premium plus risk premium. And we say generally the real rate of interest plus inflation premium, this we call the risk-free rate of interest. But now, the element that has to be now accounted for when it comes to credit risk management is this element of risk premium. So it's the element of risk premium to see exactly what is the risk that you're accounting for. Because remember, it is the risk premium, and there's also an element of what? Of inflation premium. Because if you, whenever a supplier of credit is actually charged to see exactly how much interest they're going to be charging you, it means that they also need to take into account how much inflation are they expecting over the period that they're going to giving you that loan as well. Because if they don't account fully for the inflation premium, what is going to happen? They charge you less in interest, then they end up losing out on what? On the effect of inflation as well, which means that the inflation is going to end up being too high, and then they would only have accounted for what? For a lower amount of what? Of inflation there. So which means that under accounting for inflation would result in a loss for the lender as well. Then under accounting for the risk would also result in a loss for the lender, but we're going to discuss it on the next point as well. So do you see where the accounting of inflation comes in when it comes to the charging of interest by the lender as well? Any question? On the next bullet, they say, in the second instance of devaluation of a foreign currency in which the debt is denominated, the creditor loses to the extent of the rate of devaluation. So in this case, this is where the creditor basically loses out as well, right? Like for example, if an American would have borrowed 600,000 rand in 2005, how much do they have to pay us back as principal, as the principal amount, right? Let's say, for example, if an American borrows 600,000 as the principal amount, what do we see? In around 2006, the exchange rate was around, let's say, 6 rand is equal to $1. Now, let's say 10 years later, let's say the loan was for 10 years. It would mean in 2016, it would be around, let's say it's about 15. Let me just say simplified is 5 rand here, and simplified is 15 rand is equals to $1, right? It would mean if the American had borrowed, let's say, for example, 600,000 rand, if they say, let's say, for example, they had borrowed 100,000 rand, right? It means if they had borrowed 100,000 rand as the principal amount, it means on their side, they would have had to raise an amount of 20,000. They would have had to raise an amount of $20,000 for them to be able to borrow an amount of 100,000 rand. But now in 2016, when they now have to pay back the amount of money, what is going to happen? For them to pay back the same 100,000 rand, for them to pay back the same 100,000 rand, if you do a quick calculation, if the exchange rate is now 15 rand is equal to 100,000 rand, it would mean they only had to pay back an amount of 6,667. So they'll only have to pay back, they only have to raise an amount of 6,667 to pay back the 100,000 rand. So do you see that in the cases where there's borrowing or investing involved in different currencies there, it would mean that there's losses that are going to be incurred and gains that are going to be incurred by the different parties purely because of the movements in exchange rates. So the movements in exchange rates is going to be very, very important, which means that it can also result in a loss to a particular party or to the lender because of the movements in exchange rates as well. The next example or scenario, which would also result in a loss to the lender, they say another instance will be a non-compliance with anti-money laundering measures implemented by the central banks of most of the countries. So that's why you see that whenever you go to a particular financial institution or a bank and you want to transact with the bank, they always ask you, they always have to follow the know your clients policy, where they ask you for the proof of residence and also your identification as well, so that they would know exactly who they are dealing with as well. So which means that non-compliance there would result in penalties being imposed by the by the central banks to the different banks that are also going to be transacting there. So which means that this will result in in losses to those banks that are failing to comply with the anti-money laundering measures as well. Then they say, similarly, if transactions are imposed on certain countries, then dealing with the lending or lending to the customers in such countries can also spell trouble and result in in losses. That's why you see that, for example, banks like HSBC were in the spotlight mainly because they were doing transactions with certain individuals from certain countries that were barred from that they were barred by regulation from doing transactions with such countries as well. And usually when they are found out to have done or to have not complied with such regulations, they're going to be facing penalties, which would result in big losses to the bank or financial institution as well. So those are some of the issues where even if the customer meets all their obligation, but because the financial institution would have failed to take into account these issues as well, it would result in losses to that particular financial institution as well. So if you check on the last paragraph of that page, they say, while it's the risk that a borrower may default on obligations is known as credit risk, the risk that a foreign government may fail to honor the credit-related obligations is defined as sovereign risk. So it may be noted that the legal remedies in the event of sovereign risk are limited. So hence, when extended credit to a business firm located in a foreign country, it is better to ascertain the level of sovereign risk than to study the credit risk of the business firm as well. So which means that you basically have to make sure that you also take into account what the sovereign risk is when it comes to trade, doing transactions with companies or entities in foreign countries as well. Is there any question when it comes to Unit 1.1? Any question when it comes to Unit 1.1 before we move on to Unit 1.2?
Yes, I have a question. So when the example that you use for the American, when you get to 6.6667, how did you arrive to that answer?
Remember, the exchange rate is now 15 rand is equals to $1 US, isn't it? Remember, the exchange rate now is 15 rand is equals to $1 US, right? Are we together? So which means to pay back the 100,000, the American company knows that they're owing the South African bank 100,000. So to pay back the 100,000, it means that they are, if the exchange rate is 15 rand is equals to $1 US, what does that mean? It means that the American, to find out exactly how much they need to raise the 100,000, you're going to say, what is the exchange rate? Is 15 rand. So it means that you are moving, you are moving from the weaker currency to the stronger currency, which means that you're going to be saying you need 100,000. So you need to find out exactly how much you need to raise in US dollars. So you're going to divide that by what? By 15. So if you say 100,000 divided by 15, it means the American company only has to raise 6,667 to pay back the 100,000. And initially, to get the loan of 100,000, they needed, if you look at it, how much they're going to realize in US dollars, they are going to realize how much by 100,000 divided by 5 gives you 20,000. So 100,000 rand would give them 20,000. So that's how much they're going to be having in US dollars when they borrow 100,000 rand. Then when the South African rand weakens, it means to pay back that loan, they only need to raise 6,667 to pay back the 100,000 rand loan there. So what does that mean? It's a loan, it's a loss to the financial institution, because if they had invested that money in US dollar and gotten it back, they would have made a lot more money as well. So they're basically losing out, because yes, they're still getting back the 100,000, but if they had done, the opportunity cost of giving out this loan is that if they'd invested this money somewhere else in US dollars, they would have what? Made more money themselves. Are we on the same page now?
Yes, yes, thank you.
All right. Any other questions? Any other questions? Next, we look at unit 1.2, which looks at the role of credit. And here they say, idle economic resources can be effectively put into use through credit. So here, when you look at the role of credit, they're basically saying that idle economic resources can be put into effective use through the use of credit. Because remember, this is where, for example, when you look at the financial institution, what do we see? If you look at the case of the bank, they are going to be able to utilize the economic resources are going to be able to be fully utilized, because the depositors, they are saying, I really have no use for this money now. So what am I going to do? I'm going to deposit this money into the bank. And then the bank now is going to be giving out these loans, which is the financial institution, is now going to be giving out these loans to those parties, like, for example, those people or those parties with projects where they know that if they get these loans, they're going to be able to actually make more money with these resources as well. So which means that the idle resources, which are going to be, which is the money that is going to be deposited in the bank, is now going to be more effectively utilized by the parties who needs to get these loans, because they are going to be able to utilize this money and create more money within the economy as well. This is how the economy survives, which means that the idle resources within the economy are going to be fully utilized, because if there was no use of credit in a particular in a particular economic system, it would mean that there was going to be it was going to be difficult now to link the parties who don't have excess cash and the parties where they need to actually utilize this cash and generate the economic activities as well. Then secondly, so here they say, if you check on line number 7, they say the main function of the financial system in a country is to mobilize resources for economic growth. So the financial intermediaries not only intermediate between the savers and investors, but set economic prices of capital in line with the monetary policy of the nation as well. So that's why you see that the price of capital, this is where you look at, for example, they give you, like, for example, prime plus a certain percentage depending on the credit rating. And so they'll also say, if you have a good credit rating, for example, they'll say, remember the prime rate is given as the repo rate plus 3.5%, isn't it? So from the prime rate, they're going to say, if you have a good credit record, it's either going to be prime plus a certain percentage, a lower percentage, or if you have a bad credit record, it will be prime plus a higher margin as well, depending on exactly how much they see as the risk that you're going to be taking. Because remember, the higher the risk premium, the higher the interest that they're going to be charging in the for the access of credit as well. So when you look at the role of credit, it basically means that the resources within an economic system are able to be better utilized for better economic growth as well. On section 1.3, we look at the credit market, and on paragraph number 3, they say the demand for credit is ubiquitous as the economic agents feel scarcity while pursuing unlimited ones with limited resources. So which means that it's ubiquitous basically means that it's found everywhere, which means that it's found everywhere mainly because whether you're a financial firm or a non-financial firm or an entity or an individual, the concept of credit, or the credit market is basically going to be what? Relevant for all the people who are involved in the economic system as well. Then on page 7, they also say the granting of credit to commercial customers is more complex than personal credit. This is because commercial borrowers are engaged in a much wider range of activities, and their needs for credit vary according to the nature and size of their operation. The business credit is the most common, but for which world trade and economic progress of mankind would have been impossible, which means that for they to be able to finance all these projects that we see, like for example, you look at the improvements of the road network system, like what we see with the N1, where there's this issue of the toll gates as well. And remember, this was also financed with what? With credit as well, right? So which means that all this progression that we see around us, in most cases, it's financed with what? Use of credit, either through getting loans or through what? Issuing of bonds as well. So now, what you can expect to be asked in the exam is to know exactly what is credit, as well as knowing the advantages and disadvantages of what? Of credit as well. So remember, we say the credit is basically use of what? Debt financing. So on section 1.4, we look at the credit advantages and disadvantages. So which means that when you look at the merits of credit, these are the advantages of use of credit as well. And the first one that they talk about there is that the first advantage of use of credit is wealth creation and maximization. And on line number 2, they say, while the purpose of this book is to deal with the credit risk of commercial credit, it seems appropriate to mention that even governments borrow money much along the lines of business credit. So such loans are expected to be repaid from future government revenue or foreign aid as well. So this is where, so which means that in this case, they're basically saying that the issue of credit is also relevant even if you look at it from the government's perspective. Because remember, from the government's perspective, how the issue of credit comes in is that to finance the assets, they're either going to borrow, they're going to raise the money themselves through the use of taxes, or they're going to be what? Borrowing that money from elsewhere as well, right? So which is basically the use of what? Of credit as well. So like for example, where you look at financing of these government projects as well, it's either the government will raise the money themselves, but in most cases, they are going to be what? Issuing those government bonds or those securities where they get what? Where the investors are going to be what? Buying those government bonds. And when they buy those government bonds, this is how the government is now going to be able to now raise the capital that is needed to finance what? All these projects that the government wants to pursue as well. So it means this also creates wealth, because remember, when the government borrows money and now to finance these projects, when they for them to be able to pay the different contractors who are going to be doing these projects as well, it basically means that the government will have to borrow money and then pay these contractors, then over time get back that money from the returns that they're going to be getting from the use of what? These resources as well. So on page 8, paragraph number 2, they say, if used wisely, credit helps in multiplying wealth much faster and beyond the existing resources and a nation or business enterprise or individual. That's why you see that when you look at the different forms of businesses, remember we said the different forms of businesses, either you can enter into a business as a sole proprietorship, or you can enter into a business as a company. And we said in most cases, sole proprietorship, it's difficult for them to access debt financing, so they have to finance a lot of their growth through the use of what? Their own capital that they would have reinvested, like for example, reinvesting their what? Retained earnings as well. But we see that sole proprietorships grow at a lesser rate than what? Companies, mainly because with companies, they are now able to actually access a wide range of financing, and because of that, it would basically mean that they are able to grow at a faster rate as well. So which means that when the use of credit would enable the businesses or the different entities or the different individuals to actually have a lot of growth when it comes to their wealth as well. The second one is use of credit as a tax planning tool. And here they say, In several nations across the world, income tax legislations allow the deduction of interest and installments in housing loans obtained by the salaried classes and self-employed as well. So the use of credit as a tax planning tool is where we're basically saying that when you want to reduce your tax liability, you can also utilize credit, because remember, the expense of the payments that you're going to be paying towards interest there, they're also going to end up reducing what? Your tax liability. Like, for example, if you look at the case where there is an entity with no debt, right? An entity with no debt, let's say the earnings before interest and tax is 100,000. And with no debt, it means the interest expense is going to be 0, which means that the earnings before tax is going to be 100,000. And if the tax rate is, say, okay, for simplicity's sake, I'll say the tax is 30%, it would mean they are going to be paying 30,000 as taxes. So it would mean in this case, this company will have to pay 30,000 in taxes. But now, if you're going to be utilizing debt as a tax planning tool, it would mean with a company with of debt, let's say a debt of 50,000 at 10% interest, it would mean if their earnings before interest and tax is 100,000, their interest expense would be an amount of 5,000. And if their interest expense is an amount of 5,000, it would mean their earnings before tax is going to be 95,000. And if their earnings before tax is 95,000, the taxes that they're going to be liable to pay at 30% would be an amount of 3 times 95,000, 28,500. So it will be, they are going to be liable for a tax amount of 28,500. So do you see the tax liability for a company with no debt and a company with what? With debt as well. So which means that as a tax planning tool, if you want to be paying less in taxes, you can now utilize what? Debt financing, because debt is a deductible, and if it's tax deductible, it means that you're going to be paying less. Your interest, your expenses are going to go up, and your tax liability goes down there as well. Are we on the same page when it comes to utilization of debt as a tax planning tool? We look at convenience, and here they say the owners need to bring all the funds to run the show. Often the first generation entrepreneurs who commence a new line of activity will find it difficult to amass enough funds to start to run the business. Hence, they turn to debt, which is a convenient method of raising funds which can be returned later. So when you look at debt, it basically means that instead of the entity having to wait longer to raise the money that is needed to finance a particular project so that they're able to make more money, they can now utilize debt, because it means that they have to go to the suppliers of debt and get that money. So which means that instead of waiting for a longer period of money until they raise the capital themselves, they can quickly go to the financial institution and access the debt immediately as well, which means that it becomes more convenient to access capital for the enterprise as well. The next one is business control. So what do we know? When it comes to business control, we know that the owner shareholders are the ones who are the true owners of the business. So the owner shareholders are the ones who are the true owners of the business. So because of this, it basically means that utilization of the suppliers of loan and the suppliers of bonds, which is basically the investors in the loans or the bonds as well, they have no influence on how they don't have much influence on how the company should be run, because remember, the owners of the business, which is the investors, which is the owner shareholders, are the ones who have the control of exactly what should happen in the company. So because of that, it basically means that if an entity wants to retain control of the business, instead of raising money through issuing of ordinary shares where there are more people coming in with more control of the business, which means that loss of control of the business, they would rather utilize loans or bonds, because that way it means that the debt holders would not have an influence on the control of the running of the enterprise as well. So this is basically where the issue of control comes in. We look at socioeconomic advantages, and on line number 4 they say increase in spending results in more income, rising profits, and higher net worth for the business, which in turn results in higher capacity to borrow, which encourages banks and lending institutions to lend more, increasing the spending and investment further in the economy. So all this will result in a higher employment creation and improved standards of living. So here we're basically saying that the more availability of debt would mean that the companies are going to be able to borrow more money so that they're able to make more money as well. And as they're borrowing more money to make more money, what is going to happen? It means that the banks are also going to be encouraged to give out more loans, because because they are seeing better returns from their investments as well. And this now would lead to a situation where the people who are employed either by the banks or by the companies as well, they are not going to be able to lose the risk of losing their jobs, which basically means that the employment creation is going to be increasing as there's more economic activity as well. And if there's more people employed, it means that the standard of living of the general population is also going to be increasing as well, which means that it brings out a socio-economic advantage, mainly because the standard of living of the general public is also going to be improving if there's more business activity. And remember, the business activity would be improved if entities are able to access more financing through the issue of debt financing as well. Then, are there any questions on the advantages of debt financing before we look at the disadvantages? Any questions on the advantages before we look at the disadvantages? Now, looking at the demerits of credit usage, which is the disadvantages. The first one is reduced profitability. Here they say, as far as the business credit is concerned, it is true that if the return on investment exceeds the borrowing cost, leverage is beneficial to borrowers. On the flip side, when the return on investment is lower than the borrowing cost, the business will suffer from lower profitability as well. So which means at the end of the day, we're basically saying that, is there an incentive for the entity to borrow? Because remember, if the borrowing cost, if the borrowing cost is 10% and your return on investment is 5%, what do we see? The entity will end up losing money, isn't it? So which means that now this return on investment has a risk of being affected by different elements. So there's different reasons where, for example, let's say, for example, this part we've borrowed at 10%, maybe they might be expecting that if they borrow at 10%, they were expecting that they'll generate a return of 20, let's say a return of 25%. So they were initially expecting that they'll have a return on investment of 25%. But because of the pandemic and lower business activity, the return on investment now ends up being what? So let's say, for example, 5%. They're still having positive returns, but it's 5% only. So what do we see? They are borrowing at 10% and they're only getting a return of 5%. So what does that mean? It basically means that their return is less than the cost. And remember, when you look at economic principles, it basically means that an investment is a good investment if the return is more than the cost. The moment the return is less than the cost, it basically means that it's a bad investment because it's costing the business more money And if it's costing business the money, it basically means that the value of the firm is gonna go down as well. Remember we say the goal of the firm is to maximize shareholders' wealth, not reduce the shareholders' wealth at the end of the day. So if the return is less than the borrowing cost, it means that it will result in a disadvantage of what? Use of credit as well. The next one is default and bad reputation. And when it comes to default and bad reputation, is that default is where the entity, remember when an entity borrows money, they have to pay interest. They're expected to pay interest, and they're expected to pay the principal amount, right? So when an entity borrows money, they're expected to pay interest, and they're expected to pay the principal amount. So which means default is not only necessarily failure to pay the principal amount. A company can be considered to have defaulted if they fail to pay the interest payments as well. So default is not only failure to pay the principal amount, default is also failure to pay the interest payments when they're due, or meeting the interest payment when they're due, or failure to pay the principal amount when it's due as well. So which means if a company now ends up defaulting because of different reasons, what would happen? It basically means that the company now ends up having a bad reputation. And if the company ends up having a bad reputation, it means it's got a cascading effect on the overall long-term operation of the company, mainly because now it might result in a situation where even the different stakeholders now are going to be very wary of dealing with the company. Like, for example, if the company has a bad reputation, they are not going to be able to get the proper skills because no one wants to deal with that particular company as well. And the suppliers are going to be very wary and more stricter, or even refuse to give out goods on credit. Or other suppliers of debt or financing might even refuse to give out more debt financing as well. So which means that this now ends up restricting on the overall operations of the company as well. So which means that use of credit can also end up resulting in the default and bad reputation for the company as well. Then there's also bankruptcies, and here they say almost all bankruptcies are caused by the creditors pressurizing the borrower to pay up. So bankruptcies are not good for creditors either, as they cause credit losses impacting their profitability as well. So which means that now the use of credit can end up resulting in bankruptcies, which now force the closure of the enterprise as well. Because remember, when it comes to when the companies becomes declared bankrupt, it would mean that now the creditors can now force the company to now liquidate and sell off its assets, so that they're also going to be paid whatever they can recover there as well. Which means that the mere fact that the company is now having to sell the assets and close its operations is now bad for the owners of the business, because they are no longer having that asset that generates income for them. And at the same time, it's bad for the creditors as well, because there's a high risk that they are going to fail to realize the full amount that they're being owed by the obligor as well, or the borrower as well. Next is the propensity to overspend. So the fourth disadvantage is the propensity to overspend. And they say the main disadvantage for users of credit is the tendency to overspend beyond their means. And if you go to the next paragraph, they say unexpected drying up of future inflows, say of a job, fall in income from business, suddenly delay in collection of receivables, accumulation of unsold inventories can result in repayment defaults and associated costs such as penal interest, and finally confiscation of the collateral, if any, plus the associated damage to personal prestige as well. So which means they are basically saying that the other disadvantage of use of credit is that customers, the borrowers sometimes end up overspending in such a way that they are not putting in place enough reserves, so that if there's any slow in a business activity, they have enough in their reserves to actually pay, because they know that they can still be able to access credit as well. So which means that, but we know that credit does come with obligations, like for example, interest and repayment of the principal when they are due as well. So which means that the propensity to overspend in this case is a situation where the company knows that they are going to get paid anyways. They are getting the loans, and then they are stretching themselves too much, such that if there's any disruption in the income flow, it will end up affecting the inflow. It's going to end up affecting their ability to service the debt obligations, which will result in bad reputation for the company as well. These are the 4 disadvantages that you have to make sure that you take into account when it comes to use of credit as well. Is there any question before we go on to the next section? Is there any question before we go on to the next section? So remember, we said use of credit is not necessarily a bad thing, because we know that you're using other people's money to make money, which means that you're able to create wealth at a faster rate. But now the question would be, is wealth creation through use of credit easy and simple? And what we have seen so far is that whenever there's disruption because of external factors, the entities which are highly leveraged are the ones who are going to be more affected. So whenever there's a disruption because of external factors, the entities which are utilizing a lot more credit to make more money, they are the ones who are also going to be the ones who are going to be badly affected as well. So, which means if you check on page 11, they say another interesting case is the US before the credit of crisis of 2008. We discuss this more later in the book. So which means in this case, they're basically saying, when you look at the use of credit, credit is a good thing, but at the same time, the moment there's any disruption in the market, it basically means that that's when now there is going to be a cascading effect where the companies which are owing a lot of money, they are going to fail to meet their obligations, and now they are going to be declared bankrupt and high risk of being declared bankrupt and stopping operations as well. But the companies which are having a lower use of credit as well, they have a better chance of being able to consolidate their position, ride off the storm, and now continue later on as well. So which means that use of credit is not necessarily an easy and simple thing, mainly because there are so many factors that can affect your credit position, the obligor's credit position as well. So because of this, it basically means that use of credit is not necessarily that easy and simple. Unit 1.5, we look at the different suppliers of credit. So we look at the different suppliers of credit. Unit 1.5, yeah, go through it, but I don't think they would ever ask you to say, what are the different suppliers of credit? This would be more or less like an undergrad type of question, which I wouldn't really expect them to be asking you as well. So on question of Unit 1.5, when you look at the suppliers of credit, they look at the different suppliers of credit, like, for example, the commercial banks, the lending or development institutions, like, for example, in the case of South Africa, would be the Public Investment Corporation. And then there's also the public debt market. And then on page 12, they also give us other institutions in credit financing. Like, for example, they say housing financing companies, hedge funds, non-banking subsidiaries of major multinational companies are some of the significant players in the segment. So insurance companies, they have a large pool of resources at their disposal, which are also deployed in a variety of lending or investment activities as well. The non-banking financial institutions also play an active role in the lease and hire purchase financing as well. Then there's also credit, trade credit, where they say another source of credit is the supplier or trade or manufacturer who offers credit for short periods ranging from 30 to 120 days. Like, for example, this way there's a supplier can say, I'm giving you this inventory and you pay us after 30 days or after 60 days or whatever period of time as well. So these are the different suppliers of credit as well. There's not much that we would expect to look at when you look at issues of credit. But now, remember what I told you. When you look at the issue of credit, we also look at it from the perspective of, in this case, the creditor, which is, for example, being the bank as well. So now we need to find out exactly, so how does the concept of credit also work when it comes to the concept of bank, and how banks also make a lot of money through the flow of the cash flow in the economic system as well, where there's money coming from the depositors, and then the bank now takes that money and also invest that money as well. So the reason why we say there is a lot of risk involved when, especially when it comes to the banks as well, is this example that they're giving us on page 14. So the example that they're giving us on page 14, where they say, if you look at the issue of credit from the bank's perspective, let's say, for example, the bank is obligated to maintain 10% in reserves. So whatever they get from customers, 10% of that money has to be stored in reserves, and then they can also give out as loans or invest in other bonds or other securities as well. It means, if you look at this case, for the case of the bank, what do we see? If customer A deposits 10,000, the bank is going to keep 1,000 in the reserves, and then it's going to be able to give out loans of 9,000. Now, when the bank gives out loans of 9,000, what is going to happen? It basically means that if they give out loans of 9,000, they are giving out this money into the economic system. So they are pumping 9,000 into the economic system. And what is going to happen? Now, this 9,000 that they've pumped into the economic system is going to still come back to the bank, mainly because the entities that have been given this 9,000, they are going to use this money to pay the different economic parties, and the different parties in the economy are now going to come back again to the bank. Like, for example, through, if a company gets 9,000 from the bank, through their activities of making money, they're either going to pay these employees, they're going to pay other contractors, they're going to pay so many other parties as well. And what is going to happen? These parties now are going to now deposit this money back into the banking system as well. And if they deposit 9,000 back into the banking system, the bank is now going to be obligated to maintain 10% of that 9,000, which means that they are going to take out 8,100 of the same amount back into the economic system. So the cycle continues on and on and on like that. So what do we see? Do we see that from the 10,000, there has been a total deposit of 100,000 overall that is going to end up being what? Made. So from the 10,000 that has been deposited there, there's the total deposit in the bank are going to be 100,000. The reserves are going to be sitting at 10,000, and 90,000 would have been what? Given out as advances. So what do we see? Do you see that from the initial 10,000, there's been a creation of deposit of 100,000 in the system? And the bank has now been able to give out advances or make more money to advances to a tune of what? 90,000. So this is why they say banks are highly leveraged, because the actual money that has been given to the bank is 10,000, but they've been able to make a total of advances of what? Of 90,000. That's why you see that when now there is loss of confidence in the financial system, what's going to happen? Customers, which is the depositors in the bank, they are now going to come and say they want their money. And if they say they want their money, then in most cases, the bank would not be having that money at hand, mainly because of this financial cycle that has been created there as well. That's why you see that now the central bank would now having to be what? To be involved. Like, for example, in the case of UBS Bank, where although there was money looted as well, because of the way of the financial system works as well, it basically means that the bank itself will not be having enough money available to actually meet that money if people run for the bank and wanting to access that money as well. So which means in this case, they say the amount of credit the banking system can create with a single initial deposit can be calculated by the following formula, where they say the credit creation is given as the initial deposit multiplied by 1 minus the reserve requirement. Remember, the reserve requirement is 10%. So the initial deposit of 10,000 multiplied by 1 minus the reserve requirement of 10% divided by the reserve requirement of 10%, it would give you exactly how much the credit creation would have been. So which means if you're going to do this calculation, it would mean the credit creation, the amount of credit that the 10,000 would have created would be equal to the 10,000 multiplied by 1 minus, remember the reserve requirement was 10%. So it's 1 minus 0.1 divided by 0.1. If you do this calculation, how much do you get?
$90,000.
90,000. So the amount of credit that the bank is able to now advance to its customers would be 90,000. So from the 10,000 that the customer initially deposited there, the bank is now going to be able to the bank system is able to actually give out credit with an amount of of 90,000. That's why you see that the central bank especially wants to ensure that there is always confidence in the financial system of the country, because if people run for their money, the financial system is not going to be able to sustain the withdrawals in the financial system as well. That's why you see that whenever in any country or countries where there's no confidence in the financial system, there's always going to be a lot of chaos where parties who deposit their money, they're not able to access the money from the banks as well. Are we on the same page? Any questions? So the main thing that you need to make sure that you take note of from chapter 1 is know what credit is and know the different advantages and disadvantages of credit as well. So the main things that you need to make sure that you take note of from chapter 1, know what credit is, and also know the advantages and disadvantages of credit as well. If they say merits or demerits, it's still one and the same thing as well. Any questions? Any questions? All right. If there are no questions, let's end here today. So if there are no questions, let's end here today, review chapter 1. And what I'll also do is that in the next class, I think we'll do chapter 2 and see how far we go with chapter 3 as well. So we have done chapter 1. In the next class, we should be able to do chapter 2 and see how far we go with chapter 3. So what I'm going to do is, in advance, on your user account, I'm going to now make available the video for chapter 2 and chapter 3, so that if you want to go through in advance before we go for the class, you are able to actually go through those chapters in advance before we are attending the next class as well. So that's what we're going to do. So for the next class, we're going to look at chapter 2 and see how far we go with chapter 3. I'm going to make sure that by Monday, I make the videos for chapter 2 and 3 available for you guys, so that you can also go through them in advance before we attend the class. Are there any questions?